Side B coverage to the losses of directors and officers when the company does grant indemnification. In this case, the policy will reimburse the company for legal costs. Under Side B coverage, if the company is insured when the corporate assets are at risk. Side C coverage, also called entity coverage, extends coverage for the corporate entity itself. Under Side C coverage, the company is insured and its corporate assets are at risk. The exact coverage that a company goes with ultimately depends on its unique business model, characteristics, needs, history, and financial picture. Directors and officers liability insurance process. The process of D&O insurance is in real life straightforward. It all starts when a manager allegedly fails to perform their role. Some uncommon risk scenarios include employment malpractice, reporting errors, inaccurate disclosures, insolvencies, and regulation violations. As a result, several claimants decide to sue the manager. Once the manager and the legal risk company departments are informed of the claim, then they can provide a description of the claim to the insurance broker. If the claim is covered, the insurer covers the defense costs. If the claim is covered and the case is lost, the insurer pays the defense costs and the financial loss. Of course, the example heavily depends on the terms and conditions of the specific policy. D&O insurance has become closely associated with broader management liability insurance, which covers liabilities of the corporation, as well as personal liabilities for the directors and officers of the corporation. Special considerations: D&O policies can take different forms depending on the nature of the organization and the risks it faces. It's best to seek out an insurance company with deep experience in the specialized field. Policies are generally purchased by the organization to cover individuals rather than the individuals themselves. If the company fails to disclose material information or willfully provides inaccurate information, the insurer may avoid payment due to misrepresentation. The severability clause in the policy conditions may be intended to protect against this by preventing misconduct by one insured by affecting insurance of the other insureds. However, in certain jurisdictions, it may be ineffective. Policies can be written to insure against a variety of hazards, but they generally make exclusions for fraud, criminal activity, and legal profits. Also, most policies contain insured versus insured clauses, where no claim is paid when the current or former directors and officers sue the company. This prevents the company from profiting for deceit or conspiracy.